Hello, and welcome to the latest episode of Fixed Interests. My name is Justin Patrie, a Senior Director here at Fitch Ratings, and today I'm joined by Wang, a fellow Senior Director in our credit policy team and FitchWire analyst, who also happens to be the author of Fitch's monthly China Credit Brief report. So that means we're here to talk about China today. So Lon, let's start from the top. What are the important things investors should understand about China's economy and the outlook for Chinese credit?
Hi, Justin. Thanks for having me here today. So, to answer your question, I'm going to start with our current view on China's economic landscape, and then I'll talk about three factors that we're closely monitoring for the year ahead. So, the reopening boost last year is now a thing of the past, and we see that the economic momentum in China is slowing, and it continues to grapple with challenges on multiple fronts. So, from the outside, China is feeling the pressure from weakening external demand for many traditional export products and the landscape of rising geopolitical tensions. And if we look within, the property sector in China is still on shaky ground. And this instability is spreading to other industries and having a wealth effect on Chinese households. Well, we did notice some strong data on travel and consumption patterns during the latest Chinese New Year holiday, which was in February. And these data point to some bright spots in China's domestic consumption and an ongoing demand shift towards service oriented sectors. And this trend is benefiting some companies operating in the related sectors. And this trend was also reflected in the several positive rating actions among Fitch rated Chinese corporates in recent months, such as on some casino operators and restaurant operators. But despite these positive signs, we believe the overall economic environment in China remains fragile. And I'd like to highlight three factors that we are particularly monitoring for 2024. We believe these three factors are crucial to understanding and anticipating the shifts in China's economic trajectory for this year ahead. So, the first factor is the policy support. We are paying attention to the scale, composition, and effectiveness of policy support this year, and also the degree to which such policy support will affect China's fiscal metrics and system leverage. And this will be an important driver for our credit view on the country. And as we speak, China is holding its two sessions this week and just set its annual economic growth target at around 5%. We do think this target will be a bit challenging for China to achieve if there's no significant ramp up of policy support. And the second factor we are keeping tabs on is the rebalancing process in China's economy. We know it is transitioning towards new growth drivers, the so called new productive forces. For example, renewable energy, electric vehicles, AI, high end semiconductors, and some other strategic sectors. And this rebalancing process comes with uncertainties. And any slower than expected economic growth could have ripple effects for the performance of many other sectors. And this is especially as we believe the ability of many Fitch rated Chinese issuers, their ability to cope with a severe economic downturn has declined in recent years. And finally, we are on the lookout for the overall financial stability. This remains a key focus for the Chinese authorities, and any faster than expected recognition of non performing loans at banks or possible contagion from risk resolutions at risky financial institutions could influence our outlook for the financial sector and the economy.
Okay, so three things to watch: policy support, economic rebalancing, and financial stability. But let's take a bit of a deeper dive into the housing market because I think this has clearly been a big trouble spot in China for a while now. What are Fitch's views on the state of the Chinese housing market and our expectations for 2024?
Right. So the landscape in China's property sector is still very gloomy, and our sector outlook on China's property is still what we call deteriorating. So I would discuss three trends that we've observed in the property sector. They're on the new home market, existing home market, or we call it secondary home markets, and also polarization among cities and developers. So first on the new home market. So in this market, we have not seen much improvement recently. Earlier this month, we did revise our forecast for China's new home sales to a 5 to 10% decline for this year. And this is a much larger decline than what we previously thought we would see this year. Before, we did expect new home sales to gradually stabilize in 2024 and only drop by 0 to 5%. However, recent sales data we are seeing since January this year is telling a very different story. So some local press reports suggest some larger developers in China, they actually saw a 30% year-over-year drop in new home sales in January this year. And this really underlines a continued weakening trend in China's housing demand. And this is especially given that last year's, so 2023's January, this last year January sales were negatively affected by a week-long national holiday for Chinese New Year, while this year's Chinese New Year holiday was actually in February. So if you think about this, the 30% drop was off an already relatively low base. But that being said, we do believe the government will continue to release more supportive policies for the property sector, mostly to stem the downside risk in the sector. So, for example, the latest policy move was a large cut to the loan prime rate last month. And this is the benchmark interest rates for residential mortgage in China. So, the rate cuts will lower mortgage rates and help ease the financial burden for homeowners. But perhaps the issue at the moment in China is not so much about housing affordability, but rather a lack of home buyers' confidence in developers' ability to deliver quality homes on time. And we believe the rate cut itself is probably not going to restore that confidence. And some other factors, for example, the supply demand dynamic is also changing in China's housing market, and Chinese households are also more cautious towards borrowing in the current economic condition. So these factors together are going to constrain the housing demand for a while. And next, we look at existing home market, or we call it secondary home market. There is actually some good news in this market, and we have seen some signs of stabilization. For example, momentum in sales volume prices of existing homes has actually picked up since earlier this year. But this is still very early, and we believe further improvements in this secondary home market will be quite crucial before we can see a broader recovery in China's property sector as a whole. And finally, we are seeing a continued polarization trend among cities and developers. So sales are actually increasingly shifting from lower tier cities, so the smaller cities, to higher tier, bigger cities. So this partly reflects the sentiment and population flows. And homes are usually pricier in these higher tier, bigger cities. So the shift towards these cities in the sales mix is helping keep the average selling prices for new homes more or less stable on a nationwide basis. But if we look at the price index for secondary homes, which mostly reflects mid to lower tier cities, we do expect that price index for secondary homes to drop by 5 to 7% this year. And there's also further divergence among developers. So, for example, home buyers seem to have a higher degree of confidence in state owned developers' ability to deliver homes. So, as a result, private developers, even those large scale, non defaulted ones, they are losing their grips on the market share. And we do think the state-owned developers, they might also be better positioned for the long term. This is because they have more financial resources to acquire land at this stage, and so that they can build new projects for selling the next several years. And these trends will influence our view on the property sector and also the property developers in China going forward.
Okay, final question. So since our expectations for the property sector are still pretty challenging, what implications do you foresee for China's banking and non-banking financial institutions? I noticed at the top you were saying that financial stability was one of the watch items. So if you could quickly wrap us up with what you're thinking of in terms of the financial sector in China.
Yeah, sure. So I'll start with the banks and then I'll talk about the implications for the non-banks in China. So for banks, with home sales slowing down and interest rates on the decline, we do expect profits at banks will take a hit. The Chinese government has been nudging the banks to lend more to the property sector to support the sector, the developers. But so far, we believe banks are playing it safe and still favoring the big state-owned and high-quality private developers. So, as I mentioned earlier, in mid-February, the China central bank made a large cut to the five-year loan prime rate. So, if other factors stay unchanged, we do estimate the rate cut itself could reduce the banking sector's net interest margin by 6 basis points and net profit by 5% over this and next year. Also, on smaller regional banks, the slower economic growth and extended property distress are elevating risk at these smaller institutions. Although we do not rate any smaller regional bank in China, but if the property distress continues with steeper declines in home prices, especially in some smaller cities, we could see asset quality and credit profiles at some smaller regional banks to erode further. And the government is therefore pushing for faster risk resolution at risky financial institutions to preserve the overall stability. Among our rated non bank financial institutions in China, distressed asset managers, also known as AMCs in China, they will face particularly high challenges. If things don't improve in China's property sector, we do expect AMC's profit recovery will be held back, and this will further weaken their standalone credit profiles. Most national AMCs in China, we would believe their capital levels are already very weak. So if the property distress continues and there's no credible plan to restore capital at these AMCs, we believe their ability to fulfill their primary policy function, that is acquiring and managing distressed assets, will be further compromised. And this could change our view on their credit profiles going forward.
Thank you very much, Lon, for sharing Fitch's views on China for our listeners. To learn more about all of Fitch's ratings and credit views, including summaries of our monthly China credit brief report, please visit fitchratings.com.